There is a bet you are making, right now, at this very moment. It is an involuntary wager against the people you claim to protect. The financial predator we expose today is not an institution or a fee. It is your own inaction, weaponized by a system that profits from the one thing you can never get back: time. This is our 23rd forensic audit. We have systematically exposed the hidden architecture of financial extraction, from the phantom tax ceiling episode 21 to the brutal health insurance ambush in our last investigation. The case we have built is clear: the systemic siphoning of your future is relentless. But the trap we are disarming today is different. It does not activate when you are sick. It activates when you are gone. And it executes not you but your family. Our A/B test subjects are Alex and Ben. They are 32 years old, both married with young children. Both have mortgages, the very 30-year contracts we dissected in episode 18. Their financial lives are nearly identical. But they have made one fundamentally different calculation about risk. Alex looks at his meticulously constructed budget, the one we architected in episode 20, and sees no room for another monthly extraction. He is young. He is healthy. He tells himself, "I will deal with this later, when we have more income, when the kids are older." He is a victim of the later fallacy, a cognitive flaw we first identified in our analysis of behavioral finance in episode 15. The monthly cost of a protection contract seems like a leak in his boat. He does not see the gaping hole in the hull that is his unmitigated risk. Ben performs a different analysis. He sees his family, his mortgage, and his child's future not as a source of joy but as a multi-million-dollar liability on a spreadsheet, a liability that falls entirely on him. He understands that his ability to earn an income is the single asset underwriting this entire enterprise. He views the absence of a protection contract not as a monthly saving, but as an unacceptable vulnerability in his financial fortress. He makes a small, strategic monthly payment to a third party. A payment Alex views as a waste. For 2 years Alex's choice appears to be the correct one. He has more disposable income. His compounding engine from episode 1 has slightly more fuel. Ben's payslip, the document we put under the microscope in episode 19, shows a small recurring deduction. A constant quiet drain. Then the trigger event. It is not dramatic. It is mundane. A distracted driver runs a red light. Alex is killed instantly. The system activates. For Alex's family, the first wave of the assault is emotional. The second is financial. It is swift and merciless. The income stops. The mortgage payment does not. The cost of food, of utilities, of childcare does not. The retirement account they were building, the one episode 13, becomes the only source of emergency cash. But it is not enough. Within 6 months Alex's widow is forced to sell the family home to avoid foreclosure. The carefully constructed life they had built is liquidated. The future is gone. The children's financial security is executed. All because Alex made a bet that he had more time. A bet he lost. Now we run the simulation on Ben. The same accident. The same tragic outcome. For Ben's family, the emotional devastation is identical. But the financial outcome is not. A few weeks after the funeral, a check arrives. It is a quiet, non-negotiable, contractual transfer of funds. The amount is enormous. It is a sum calculated to replace a lifetime of his lost income. The mortgage is paid in full. A separate fund for the children's education is established. A new stable source of income is created for his widow, giving her the one thing the system is designed to steal: time. Time to grieve, time to rebuild, time to raise her children without the crushing weight of financial ruin. The event was a tragedy. It was not a catastrophe. What was the architectural secret Ben understood? He knew that the system's most effective weapon is the psychological illusion that we are invincible. The system preys on our optimism. The cost of buying protection is visible as small monthly annoyance. The cost of not buying it is invisible until it is total and absolute. We are now past the 85% mark. It is time to name the components of this system. The instrument Ben used is life insurance. It is a contract that neutralizes the financial risk of death. Alex's fatal error was believing this was a product for the old or the wealthy. It is a tool for anyone whose death would create a financial void for someone else. The system is built on two primary architectures. The first is what Ben used. It is called term life insurance. It is a pure protection instrument. You are in effect renting a massive financial safety net for a specific period or term, typically 20 or 30 years, the same length as your mortgage. It is brutally efficient and surgically precise. Its only job is to pay out if you die within that term. The cost is remarkably low because the probability of a young healthy person dying is low. The second architecture is a complex, bundled product. It is often called whole life or permanent life insurance. This product attempts to mix a protection component with a low-return investment vehicle. As we discovered in our analysis of ETFs versus mutual funds in Episode 5, bundling different financial jobs into one high-cost product is almost always a system designed to benefit the seller, not the buyer. For the vast majority, the clean, unbundled efficiency of a term policy is the superior forensic choice. It separates the job of protection from the job of investing. This knowledge is your empowerment. You are no longer a gambler. You are a risk analyst. Here is your execution protocol. First, quantify your liability. Do not guess, calculate. Add up your mortgage, your debts from Episode 9, and the total income your family would need to replace. A common forensic benchmark is 10 to 12 times your annual salary. Second, select the correct architecture. For 99% of cases, a simple term policy is the most efficient and logical tool. Third, understand the pricing mechanism. The premiums are based on your age, your health, and the size of the payout. The system rewards those who act when they are young and healthy. Procrastination is a guaranteed price increase. Fourth, execute. The single greatest risk is delay. Your inaction is a loaded weapon pointed at your family's future. Disarm it. You have now seen the blueprint of the procrastination trap. It is a system that leverages your most human instincts against you. Your hope for a long life becomes the very vulnerability the system exploits to bankrupt your legacy. You have the power to close this vulnerability. The cost of doing so is small. The cost of inaction is infinite. This final layer of protection completes the foundation of a truly resilient financial fortress. It is a duty of care, a non-negotiable component of a responsible financial life. Building this fortress is a solitary responsibility, but the blueprints are something we must continue to share and examine together. Our mission is to tackle the financial questions you are actually asking. Let us know in the comments what practical challenges you are facing, and your idea could shape an episode. Subscribe and join the conversation.